Welcome to this wonderful chapter again. So today's topic is very important. We will learn a lot of basic concept. Pay attention. This question we have solved. This was a very basic question just to introduce the concept of foreign exchange to you. Now we'll come to next concept called forward contract or forward rate. Forward exchange contract or forward rate. Very similar to what you have studied earlier. A forward contract means a contract entered into today, rate decided today, but the execution will take place at a future date. So it's a contract to buy or sell a specific quantity of a specified foreign currency at a specified rate at a future date. The important thing is that rate of exchange is negotiated in advance and the actual delivery of the foreign exchange and the home currency will take place at a future date. So if you are an importer or an exporter, you can effectively use forward contract to hedge your risk. You can lock the exchange rate well in advance and then you are not worried about the movement of the exchange rate. So that is the forward contract, and of course forward contract can be used for speculation also, for arbitrage also. But in this chapter we will see the use of forward contract basically for hedging purpose. So what is a forward contract? Forward exchange rate occurs when buyers and sellers of currencies agree to deliver the currency at some future date. They agree to transact a specific amount of currency at a specific rate at a specified future date. So today only they will enter into a contract to exchange a specific amount of a specific currency on a specific future date. So the rate is already fixed in advance. Actual delivery of foreign exchange and home currency will take place at a future date. So if you are using forward contract for hedging purpose, this is a very good instrument. You will lock the rate well in advance. The forward exchange rate is set and agreed by the parties and remains fixed for the contract period regardless of the fluctuation in the spot rate in future. So now whatever may be the spot rate in future, you are not worried. You are going to receive or pay foreign currency at the specified rate. So the rate of exchange which we use in forward contract is called forward rate. Spot rate means rate as on today. Forward rate, rate that will be applicable to a future transaction. However, the rate is negotiated well in advance. The actual spot rate on that date may be lower or higher than the agreed forward rate. Now there is an advantage also and there is a disadvantage also of entering into a forward contract. What is the advantage or disadvantage? Just try to understand. Suppose you are an exporter. An exporter is going to receive $1 lakh after 3 months. So what he does, he enters into a forward contract. The forward rate agreed is, for example, 75 rupees per dollar. Now what can happen after 3 months? After 3 months, the forward exchange rate can be say 68 rupees per dollar, or forward exchange rate can be 79 rupees per dollar. Anything is possible after 3 months. If it is below 75, then exporter benefits. The exporter benefits because by entering into a forward contract, he has ensured that he will get 75 rupees. So he will gain 7 rupees per dollar. Had he not entered into forward contract, he would have received at the rate of 68. But now because he has entered into a forward contract, he will receive at the rate of 75. But there is a disadvantage of entering into forward contract. You will not be able to enjoy the upside gain. See here, after 3 months the rate has gone to 79. But because forward contract is entered into, forward contract give rise to a right and obligation. That means you are bound by the contract and you will have to convert dollar into rupees at forward rate, that is 75. So you will not be able to enjoy the upside gain here. You are protected from the loss, but you can't enjoy the upside gain. That is the disadvantage of forward contract. But what was your objective? Your objective was to hedge. Are you able to hedge? Yes. Are you satisfied? Yes. So when you are using forward contract for hedging, your aim is not to maximize the profit. Your aim is to minimize the risk, and that is what we have achieved. You should be contented, not restless. When you are using forward contract for hedging purpose, then you should be contented and not restless. You might miss some profit opportunity in that case, but at least for next 3 years you are able to sleep peacefully. Now please come to question number 2. Printed in your book, question number 2 on 1st March. Following rates were provided. Spot rate $1 is equal to 50 and 3 months forward rate is $1 is equal to rupees 55. So today if you want to buy or sell dollar, you can do it for 50 rupees. But if you enter into a forward contract, then after 3 months you will be able to buy or sell dollar at rupees 55. Question is, Mr. Anil Ambani had to attend an urgent meeting on 1st March in USA. Today is 1st March and he wants to attend a meeting in USA on 1st March itself. He needs $2,000 for the meeting. Find out the applicable rate. How much Mr. Ambani will pay in rupees to acquire $2,000. So first you write down the answer of this question there only. Applicable rate. 2 lines I have to write. Which rate is applicable? The applicable rate is equal to spot rate. Spot rate is rupees 50 per dollar. In bracket you can mention spot rate because today is 1st March and he needs $2,000 on 1st March only. So the conversion will take place at 50 rupees. Question is, how much Mr. Ambani will pay in rupees to acquire $2,000. Amount to be paid in rupees. Amount to be paid in rupees is $2,000 multiplied by spot rate 50. So check the answer. Is it 1 lakh? Is it 1 lakh? Yes. This is your answer. Only write this much. These are just warm-up problem. Just to start the chapter, we need to start with some basic things. As we'll move forward, the chapter will become little more difficult. And then the next question is, suppose Mr. Ambani postpones his meeting for 3 months. Now he wants to go after 3 months, not today. Find out the applicable rate and amount to be paid after 3 months. So now write down the applicable rate. Write down below the question applicable rate, or write in the notebook, is equal to rupees 55. So he knows that I have to go after 3 months. So he will book a forward contract. Lock the rate today only, so that afterwards if the rate goes up, he does not suffer the loss. Applicable rate rupees 55 per dollar. and the amount to be paid in rupees is equal to $2,000 into 55. So that is rupees 1,10,000. 1,10,000. Rupees 1,10,000. Next concept today, very important, is understanding exchange rate quotations. Exchange rates are quoted in two ways. They are called direct quote or indirect quote. Direct quote and indirect quote. So every problem that you will read, you need to identify what is the home currency, what is the foreign currency, what is the exchange rate given to you, and after reading the exchange rate you have to define whether it is a direct quote or whether it is an indirect quote. So but you should know what is a direct quote. A direct quote denotes the number of units of the domestic currency required to buy 1 unit of foreign currency. So we will say in simple terms, home currency, you can write if you want, per unit of foreign currency. Number of units of home currency required per unit of foreign currency is called direct quote. Look at the example. Suppose in India, $1 is equal to 49 rupees. It means you can also write like this, rupees 49 per dollar, or you can present like this, rupees per dollar is 49. You can write like this, $1 is equal to rupees 49. In three ways the questions will come in your question book. All are same, rupees 49 per dollar, rupees per dollar is equal to 49, $1 is equal to 49. It means number of units of home currency. Home currency in India is rupees 49. 49 rupees are required to get 1 unit of dollar. Dollar is foreign currency in India. So therefore it is a direct quote. Therefore it is a direct quote for an Indian. It is a direct quote for an Indian. 79 rupees per euro is a direct quote for an Indian. 95 rupees per pound, this is pound, is a direct quote in India. $1.2 per pound is a direct quote in, fill in the blanks, direct quote in dash. $1.2 per pound is a direct quote in USA, is a direct quote in USA. 5 ringgit per dollar is a direct quote in, fill in the blanks. 5 ringgit per dollar is a direct quote in dash. Then some of you are wondering, what is this ringgit? I have never heard ringgit. Dollar I know. So ringgit is the currency of Malaysia. So it is a direct quote in Malaysia. So this chapter will sometime test your general knowledge also. One should know currencies of different countries, at least main countries you should know. In the case of direct quote, in your book I have written everything. In the case of direct quote, number of units of foreign currency is kept constant. Number of units of foreign currency means $1 will be kept constant. and if you have to change anything, the change will be made in rupees. Suppose I said dollar has appreciated by 10%. Value of dollar has gone up by 10%. So what is the exchange rate after the dollar appreciates by 10%? My answer will be $1 equal to, so I will keep this as it is, and now the dollar has become more expensive, so I will add 10% and I will say $1 is equal to rupees 53.9, or we say dollar has depreciated by 10%. What is the new exchange rate? So I will say 49 minus 10%. So the revised rate will be $1 is 44.1. So keep the foreign currency constant, $1, 1 pound, 1 euro, and any impact of change in the value will have to be given in the home currency, will have to be given in the domestic currency. So in India we are more comfortable with direct quote because we have the custom of convention of using direct quote in India. So all the rates that you see in the newspaper, television channel are direct quote. They will say today the dollar was 76 rupees per dollar. To the rate for pound was 97 rupees per dollar. Euro was 83 rupees per dollar, like that. So we are more used to direct quote. However, there are certain countries where the convention is to use indirect quote. What is indirect quote? Indirect quote means number of units of foreign currency. Number of units of foreign currency per unit of domestic currency. Number of units of foreign currency that can be exchanged for 1 unit of a domestic currency. So in the indirect quote, the unit of home currency is kept constant and any change in exchange rate is affected by changing the number of units of foreign currency. So before reading this big line, let us understand indirect quote. Suppose we use indirect quote in India, suppose only, what will be the rate of dollar and rupees in India? Then we will quote like this: $0.0204 is equal to rupee 1. And how did you get this number? 1 divided by 1.49. Yes. So if I take the reciprocal of 49, 1 by 49, I will get this number. So 1 by $49 is equal to rupee 1. In India, this will be an indirect quote because foreign currency per unit of rupee, per unit of home currency becomes an indirect quote in India. So, but in India we don't use this way of quotation. However, you must know, because in some questions which we are going to solve very soon, they have given you indirect quotation. Okay, so now you answer my question. 1.3 pound, $1.3 equal to 1 pound. $1.3 is equal to 1 pound. My question is whether it is a direct quote or indirect quote in UK. Whether it is a direct quote or indirect quote in UK. $1.3 is equal to 1 pound. You are a UK citizen. So whether it is a direct quote or indirect quote. So the answer is it is an indirect quote. It is an indirect quote because the currency of UK is pound. So if 1 pound is given and against 1 pound the rate is given, the exchange rate is given, so it will become indirect quote in UK. But what about US? Is it a direct quote or indirect quote in USA? So in case of USA, this will become a direct quote. In case of USA, this will become a direct quote. Okay, try one more. 50 won per yen. 50 won per yen. Is it a direct quote or indirect quote? Is it a direct quote or indirect quote? Under that two questions, in Japan, and second question in Korea. So first answer, whether it is a direct quote or indirect quote in Japan. So in Japan it is an indirect quote because the currency of Japan is yen. But in Korea this will be a direct quote. Home currency is won. Number of units of home currency per unit of foreign currency is called direct quote. So this way you will be tricked in the exam. 1.1 euro is equal to 1 pound. Answer, is it direct quote or indirect quote in Germany? Question number B, UK. Is it a direct quote or indirect quote in Germany? 1.1 euro is equal to 1 pound. So this will be a direct quote in Germany and this will be an indirect quote in UK. If you, once these basics are clear, we can solve the problem, because some calculations will get affected because of the type of quotation. So here, what is the relationship between direct and indirect quote? Direct and indirect quotes are reciprocals of each other. That means direct quote is equal to 1 upon indirect quote. Indirect quote is equal to 1 upon direct quote. So if you are given $0.0204 per Indian rupee INR, convert this into rupees per dollar, convert it into direct quote. What will you do? Just take 1 divided by 0.0204. So that comes to 49.0196 rupees per dollar. This way you can convert an indirect quote into direct quote. Or suppose you are given exchange rate is 75 rupees per euro. Given 75 rupees per euro, it is a direct quote in India. Agreed? Find out its equivalent indirect quote. What is its equivalent indirect quote? So the equivalent indirect quote will be simply 1 by 75. So take on your calculator 1 divided by 75. So that is 0.0133 euro per rupee. So that is the equivalent indirect quote in India for euro. So in some cases we may have to convert direct quote into indirect quote or indirect quote into direct quote. Just take the reciprocal, but some more complication will arise as we'll go ahead. Now student will ask, why do we need to use indirect quote? Now that has become convention in some countries, I have told you. For example, if you go to London, UK, you will find that everybody is giving you a quotation in pound. So you suppose reach London airport, that airport is Heathrow, big airport, there are a lot of exchange counters, Thomas Cook, and so many others. You will find on their board, that electronic board, it will be written 1.05 Australian dollar, 1.3 US dollar, 1.15 euro, 96 rupees, 96 rupees, then maybe 180 yen. What is all this? All these are per pound. Whether per pound is written or not, you need to know the convention of that country, that all the rates are quoted as per pound. Similarly, there are other countries also, like South Korea also. Once I had gone to South Korea, there also I found that they are using indirect quote. Everything is expressed as per won, the currency of South Korea, won. So most of the countries will be using direct quotes, like USA, India, but some countries like UK, South Korea, they use indirect quote, and it has become a convention over a period of time. So once the conventions are established, difficult to change. Example of convention: in India, we drive on the left side of the road, but if you go to USA, they drive on the right side. Now that has become a convention. If you ask that from tomorrow, all the Indians will start driving on the right side, what will happen on the first day? There will be lot of accidents, because we are used to only left hand side driving. So that is called convention, and then it is difficult to change. Or for example, in accounts, debit, credit. If this is an account, the left side is debit side, the right side is credit side. Tell all the accounts students from tomorrow, the government has passed a new rule, debits will be on the right side, credit will be on the left side, okay, and change all your accounting accordingly. It will become so difficult for you to adjust. That is why direct quote, indirect quotes both are used in different countries. In India, direct quotation is used. So all the rates that you will find is direct quotation. What is direct quote in one country is an indirect quote in another country. Very true. Now if I say rupees 52 per dollar, is it a direct quote or is it an indirect quote? Then you should ask, which of the two is home currency? If I say rupee is home currency, then it is a direct quote. But if I say dollar is the home currency, then it is an indirect quote. So what is a direct quote in India? Same becomes indirect quote in USA. Now the time has come to solve a question, and you have to also note down this question there. Draw this table and then you write down these three columns which is a part of the question, and these three other columns which are blank columns you have to complete. First line is printed in your book, question number I think 3 in your book. 3, this is question number 3 in your book. Right, I will call it question number 3. 2 was Anil Ambani. A Mumbai dealer, underline Mumbai. Mumbai is your home state or home country, whatever you call. So since Mumbai is mentioned, it means in all question rupee will be our home currency. Rupee is our home currency. A Mumbai dealer has given the following quotes. Identify What are the question? Whether these are direct quote or whether these are indirect quote. For each direct quote, give the corresponding indirect quote. So if you are saying that this is a direct quote, what is its equivalent indirect quote? If you are saying it is an indirect quote, then what is its equivalent direct quote? Right? So draw a table with 6 columns: currency, rate, quote, nature of quote, computation, and other quote. So if you say it is a direct quote, then in other quote you have to write down its equivalent indirect quote. And any calculation if you want to perform, you will show that calculation in this column. So I repeat: currency, rate, quote, nature of quote, computation, other quote. In currency column write Swedish kroner. One next line, AUD, Australian dollar, AUD. UAE dirham. Currency column euro, Omani riyal, Omani riyal. So 5 cases I will give it to you. Now this is only a very basic question, concept problem for understanding direct and indirect quote, not for exam. 5.75, 0.0316, 12.13, 0.0191, 117.69, 117.69. Then quote write down rupees per kroner. This 5.75 rupees per kroner. 0.0316 Australian dollar per rupee. 12.13 rupees per dirham. 0.0191 euro per rupee. 117.69 rupees per Omani riyal. After writing this question, now you have to complete. One, I will show you how to do it. You are in India, rupees home currency. If the quotation is number of rupees per unit of foreign currency, then it is a direct quote. So you will write here direct quote. Computation for convert into indirect quote. To convert into indirect quote, I will take reciprocal 1 divided by 5.75, and then on your calculator 1 divided by 5.75 equal to 0.1739 kroner per rupees. Kroner per rupees. In the same way, now you will solve 4 more lines. Each line 2 seconds. So please solve other 4 lines on your own. At least try. Take a pencil and write. In case if you make mistake, you can erase and write the correct answer. So all our dear students are trying this wonderful question number 3 for learning direct and indirect quote. Please try. If you try on your own, you will learn more. So I have designed this chapter in such a manner that we'll start from very basic and slowly we'll go to advanced questions. Okay, done. Let us check the answer now. Dear students, please check the answer. The second one, Australian dollar per rupee, is an indirect quote and the other quote is 31.65 rupees per Australian dollar. Check the third one. Rupee per dirham is a direct quote in Mumbai. Its equivalent indirect quote is 0.0824 dirham per rupees. Euro per rupee is an indirect quote in India and its equivalent direct quote is 52.3560 rupees per euro. Rupee per real is a direct quote in India and its equivalent indirect quote is 0.0084 real per rupees. So this is how the exchange rates are converted from direct quote to indirect quote. So we have studied till now some important thing. What is home currency, foreign currency, exchange rate, how exchange rates are determined, direct quote, indirect quote, the relationship between direct quote and indirect quote, home currency, foreign currency. Now, very important tick mark, next 2 points, bid price and offer price, because the entire chapter will require you to understand bid price and offer price. So one day you had gone to your office, the article student goes to his office, his boss says, I have to go to USA, go to this bank and find out what is the exchange rate they are quoting. So you took your two-wheeler, you went to that bank, the bank said, today we are trading dollar at 75.76. You are confused. 75.76, what does that mean? So that is where you have to understand what the bank is trying to say. The bank is trying to say that we are willing to buy dollar from you at 75. So this is called bid rate, bid price. But in case the customer wants dollar from the bank will provide dollar to the customer at 76. So this is called offer price or ask rate, or in simple term, selling rate. Bid rate is also called buy rate, buying rate, the rate at which the foreign exchange dealer is ready to buy the foreign currency. It is the rate at which the foreign exchange dealer is ready to buy the foreign currency in exchange for domestic currency. So this is the rate at which the bank or the forex dealer will buy foreign currency from you. So that is 75. Now the bank will ask you, do you want to buy dollar or do you want to sell dollar? So you will say, my boss is going to USA, so I want to buy dollar. So customer will want to buy, but what the bank will do? Bank will sell him the dollar. So bank will say, go and tell your boss that we are going to charge you 76 rupees per dollar. So that ask rate will become applicable to your boss. So bid rate is also known as buying rate, the rate at which the forex dealer will buy foreign currency from you and give you domestic currency. So at bid rate, bank or forex dealer, what they do? They buy foreign currency from the customer and pays home currency to the customer. This you have to understand. Banks give you two-way quotes. In foreign exchange market, the interesting thing is that the banks will give you two-way quotes. Two-way quotes means they are willing to buy also dollar from you and they are willing to sell dollar to you. They are willing to buy dollar from you, they are willing to sell dollar to you. So that is why it is called two-way quotation. Because there can be some customer like exporter who wants to sell their dollar to the bank. They want to convert dollar into rupees, exporter. But there will be importer who wants to convert rupees into dollar. So therefore, to the exporter they will apply buying rate, to the importer they will apply the selling rate. So it is buying rate. Now let us first look at the ask rate or offer price. Ask rate or offer price means it is the rate at which foreign exchange dealer asks its currency to pay in local currency in exchange of the foreign currency. In simple term, it means it is the rate at which forex dealer is selling you the foreign currency. Foreign exchange dealer or the bank is selling you the foreign currency. So they will say, give me so much of rupees and I will give you $1 against it. So it is the selling rate or offer rate at which foreign currency can be purchased from the dealer. So I'll go back to the same example. Your boss in the early morning tells you go and ask the exchange rate from the bank. You go there, bank says rate is 75, 76. You come and tell your boss bank said 75, 76. So now which rate will be applicable to your boss if he is traveling to USA? The boss is the customer of the bank. So he will go to the bank, give him rupees. Boss will give rupees. Bank will sell him dollar. So bank will charge him 76. Suppose your boss requires $2,000. So how many rupees he will have to pay? He will have to pay 1,52,000 rupees. After 1 month, your boss returns. After 1 month, your boss returns and he has got $500 left with him. He thinks, what I will do with this $500? Let me get it converted into rupees. Again he tells you, article, go to the bank, ask for the rate. So bank says rate is 75.50 because exchange rate will keep changing, 76.50. You come and you tell your boss, sir, he is telling you the rate is 75.50 - 76.50. Your boss has got $500. He wants to convert into rupees. So now the question will be, at what rate the bank will convert $500 into rupees and give you the rupee amount. Now the bank is buying dollar from you. The bank is buying dollar from you. So bank will give you at the rate of 75.50. So 500 into 75.50, bank will transfer 37,750 rupees in your account. Then you will go to the bank and say, sir, you are cheating. When I had purchased dollar from you, you charged me this rate. Now when I am selling you dollar, you are only providing me this rate, lower rate. You are cheater, you are looter, you are a fraud. No, this is not what you should say. You should know the rule of the game. The bank buys from a customer at a lower rate, sells at a higher rate. This way they make the profit. Because throughout the day there will be customers who would want to buy $10,000. And during the day there are 10 customers who want to sell $10,000. So what it is doing? It is buying at a lower rate, selling at a higher rate, and thereby it is making profit. So that difference between buying rate and selling rate is called spread. So that spread is because the bank wants to cover its administrative cost and also to make some profit. Bank is a dealer in foreign exchange. For them, foreign currency is the inventory. And like any dealer, what dealer does, what a businessman does, they buy at a low rate, sell at a high rate. So that is why there is a difference. Now paragraph 23, which is more applicable for your classroom and exam question, less applicable in the practical world. It says one-way exchange rate quotation. One-way exchange rate quotation means when the bid rate and ask rate are same. That means you ask the bank what is the rate, they just say 75. 75 means bank is willing to buy at 75, bank is willing to sell at 75. So as I said, practically this may not happen, because always there will be a gap between the bid rate and the ask rate. The ask rate will be more than the bid rate, so that the bank or the dealer can make profit. But because you are a student, many questions just have only one quotation. Just like I have written 75 rupees per dollar, and the student is required to solve the problem. So he will use this as a bid rate also, and he will use it for ask rate purpose also. However, when two rates are given, 75, 76, then he has to be careful when to apply bid rate and when to apply ask rate. The rates are quoted by the bank or the forex dealer, that is those who are dealing in foreign exchange. They have given these rates. So you have to see whether this bank or foreign exchange dealer, is he buying or is he selling the foreign currency. If they are buying, apply buying rate. If they are selling, apply selling rate. In other words, when bid rate and ask rate are not separately given, the quotation is called one-way quotation. Example, $1 is 50. It means the bank is willing to buy at 50 rupees per dollar, bank is willing to sell at 50 rupees per dollar. This will happen only in your classroom and exams. In real life, this may not happen. Otherwise, the bank will not make any profit. What we will find in real world, when you go to any dealer, they will give you two-way quotation. They will give you two-way quotation. You can check it also. If suppose you have a bank near your home or office, after this lecture is over, go there and you will find that there are two rates mentioned there on their electronic board, bid rate, ask rate. But they don't write bid rate, ask rate, because many people will not understand. So they will write here, we buy at, we sell at. Easy for normal person to understand. And then they will write here name of the currency, dollar, pound, euro, and they will write we buy at 72, we are selling at 73, pound we are buying at 94, selling at 95, euro we are buying at 85, selling at 86, like this. Which means they will buy foreign currency from you at these rates. But in case if you want to convert your foreign currency into rupees, or in case if you want to convert your rupees into foreign currency, then they will sell you foreign currency at higher rate. The difference is the profit margin. Difference is the profit margin of the bank or the dealer. Or sometimes suppose you go to some hotel also, 5-star hotel or some good hotel, near the reception also you will find a very nice board. red velvet, okay, cloth, and then in golden embossing they will write dollar, pound, euro, yen, and then same thing they will write today we are buying at, today we are buying at and selling at, and then again the rate. Now in the hotel the rate will be right like dollar 70 they are buying, 75 they are selling, so they are making more profit because you are in a hurry, you don't have time, so you will accept whatever they will give you. So they will take $1 from you and give you 70, but if you want dollar they will charge you 75, pound 90, 99, euro 80, 87, yen 140, 180. Yen is not properly written. Yen is 0.40, 0.50. In case of yen, it is less than 1 rupee. Rupees relatively has a higher value as compared to yen. So in a two-way quote, bid rate will precede the ask rate. So if the exchange rate is quoted to you like this, 45-47, 45 will always be bid rate and 47 will always be ask rate. So bank will make a 2 rupees profit if they quote like this. From the customer they will buy dollar at 45. To a customer they will sell dollar at 47, and this way they make the profit. And the difference between this bid rate and ask rate is called spread. So in our example, spread was 2 rupees. The difference between bid rate and ask rate is called spread. The ask rate is always greater than the bid rate, as the dealers make money by buying at bid price and selling at offer price. So just like suppose you are an apple vendor. Don't write, understand only. You are an apple vendor. So what you do? This is your shop. You will purchase apple from a wholesaler at 130 rupees per kg, and you will sell to the customer at 140 rupees per kg. So this is the rate at which you buy apple, this is the rate at which you are selling the apple, and what is your spread? 10 rupees. It can't happen that you buy at 140 and you sell at 130. You lose money. Same thing happens for foreign currency. For a forex dealer, the foreign currency is like an apple. Buy at low price, sell at high price. Make profit. See one more example for you. A dealer in India quotes Indian rupee as rupees 43.80 and 43.90. So what is bid rate? 43.80. What is ask rate? 43.90. What is the spread? The spread is 10 paise, rupees 0.10. Now I am going to give you today two golden rules which you don't have to forget till you get 200 plus, okay, in group 1, and individually minimum 40. Till that time remember these two golden rules. The golden rule number 1, if suppose it is a direct quotation, we have seen how to understand direct quotation. Number of units of home currency per unit of foreign currency is called direct quotation. So in the direct quotation, in India we use direct quotation and we are used to this rule. All of you already know this rule. Buy low, sell high. Buy low, sell high means the bank or the dealer will buy foreign currency at the lower rate and sell the foreign currency at a higher rate. That is called buy low, sell high. But in case of indirect quotation, the rule is buy high, sell low. Now for direct quotation, understanding is easy. One example is also printed in your book. 43.80, 43.90. So bank will buy at this rate, sell at this rate. For understanding purpose, let us see the inflow and outflow of the bank. So here the bank buys dollar. When bank buys dollar, dollar comes in, rupees go out, so outflow. Bank sells $1. When bank sell $1, dollar outflow of 1, rupee inflow 43.90. Calculate the gain. $1 inflow, $1 outflow. So now you have $0 left with you. But when you look at the rupee, you are left with a 0.10 surplus here. So this way you made the profit in case of a direct quote. Direct quote is very easy for us to understand because we are used to it. In India, we have been using direct quotes. You have applied direct quotes in your day-to-day life. The difficult part is understanding indirect quote. But again, I'll explain you with example, with logic, and you will understand. In an indirect quotation, what is indirect quotation? Number of units of foreign currency per unit of home currency. The quoting bank will apply the rule buy high, sell low. Now this is undigestible. Buy high, sell low. Are you a fool? You will suffer a loss. Don't do that. Okay, let us understand with the help of an example why the logic is buy high, sell low. Let us take an example. Once I complete explaining this example, you will be convinced why for indirect quote the rule is buy high, sell low. Suppose the rate is 100 rupees is equal to USD 2.0762 and this is to be read as 2.0767. Now I will tell you why 100 is given. It can be rupee 1 also. But normally if I write rupee 1, then I will have to write like this 0.020762 dash 0.020767. It is so difficult to read the numbers which are in fraction and that too so many zeros here. So what they do, it is an indirect quote, but to make it easier for understanding, they multiply 1 rupee by 100. Sometimes they multiply by, in case of some currencies, 1000. So that easy for anybody to understand. Understanding fractions become very difficult sometimes. So what this bank is doing, buy high, sell low. Which currency they will buy high? Dollar, foreign currency. Sell low, foreign currency. Which figure is higher here? 0767. It means bank will take from you. Now you understand, concentrate. Bank will take from the customer $2.0767, $2.0767, and bank will give him 100 rupees. So bank is buying dollar by applying the higher figure. So it receives $2.0767. and pays 100 rupees. Sell low. Sell low means bank will give you $2.0762 and bank will receive from you 100 rupees. Let us read this note, then we'll take a tabular format to understand. The quoting bank will receive $2.0767 per rupees 100 while buying dollar. So what is the inflow? The inflow is $2.0767, the outflow is rupees 100, and at the same time sell low. At the time of selling dollar, bank gives away lower figure, USD 2.0762 per rupees 100 while selling dollar. So outflow of USD is 2.0762 and inflow is 100. So what is the profit of the bank? Profit of the bank will not be in rupees now. Rupees 100 outflow, rupees 100 inflow. Net rupee inflow or outflow is 0. But when you look at the dollar, dollar inflow is higher than dollar outflow, and therefore the bank will make a profit here in terms of $0.0005, right? Now wait a minute, I will explain you with the help of table which is already given in your book. This is dollar, this is rupees. Bank sales, so sell low. Outflow of dollar 2.0762. Rupee inflow 100. Bank buys, buy high. So bank will buy from you dollar by asking you to give 2.0767, and in return the bank will give you 100 rupees. Now let us look at the net flow, net cash flow. Rupee net cash flow is 0, but dollar is 0.0005 positive. So for every 100 rupees, the bank is going to make a profit of $0.0005. This way the banks make profit, right? So the rule for indirect quote is buy high, sell low. Whenever you have doubt, you can come to this paragraph 25 and check the example. Sometimes indirect quotation trouble you because you are not used to indirect quotation. Just like you are not used to driving on the right side of the road. You are not used to writing the debit items on the right side of the ledger. But then you slowly get used to that. For example, in India, when we used to prepare balance sheet under Schedule 3, before Ind AS was there, first we will write equity and liabilities, then assets. But now when Ind AS has come, what do? We write asset first, followed by equity and liabilities. But over a period of time, we have adjusted ourselves to that now. Paragraph 26, you have to do some fill in the blanks work. Write down interpretation of bid rate and ask rate. Interpretation of bid rate and ask rate. So one important thing you will remember, that ask rate will be greater than bid rate when it comes to direct quote. Ask rate is greater than bid rate when it comes to direct quote. So assuming all these are direct quotes, let us interpret. Write down 4 columns in your book there or in notebook, wherever you want. Serial number, rate, bid rate, ask rate. Serial number, rate, bid rate, ask rate. First case number A, $1 is equal to rupees 45.30 slash 70. So how do you interpret this? Out of this, what is bid rate and what is ask rate? So the bid rate will be 45.30. Bid rate will be 45.30 and the ask rate is not 70 rupees. The ask rate is 45.70. The ask rate is 45.70. So these are certain conventions which are followed in this market. So this 30 paise will be substituted by 70 paise, and then you have to overall check. Overall check is ask rate is greater than bid rate. Yes, satisfied. Now the trickier one is this one. Rupees 45.30. Second one, write down B. $1 is equal to rupees 45.30 slash 10. Now if you are in a hurry in the exam, suppose you are in a big hurry, you want to go home, you want to meet your mother. So you will write bid rate 45.30 and then you will write here ask rate 45.10. This is how you are taught. First one is bid rate, second one is ask rate. But now you look at the inconsistency. You have made a blunder. Your ask rate is lower than your bid rate. What you are doing? If this is the situation, somebody will go to the same bank. First, that customer will buy from that bank at 45.10 because bank is willing to sell. And to the same bank, you will sell at 45.30. The bank will become bankrupt. RUFT added. Bankrupt. Bid rate has to be low. Ask rate has to be high. In that case, what I'll do, I will change this number. I will take the next higher number. So if it is 45, the next number here will become 46.10. It should not be less than the bid rate. Normally institute does not give you such difficult adjustment because these are very technical and only people working in banks are able to interpret it nicely. But still, who knows? The institute may be in the need of money. They want repeat customer. So they can ask you such questions. Now next is even more complicated now. £1 is equal to $1.3640 slash 70. Bid rate is easy, 1.3640. What about ask rate? So some student in a hurry will write 1.70. The answer is wrong. How many digits are here? 4. How many digits are here? 2. So what you will do, this 70 you will substitute here against 40. You start substituting from the rightmost number. So this 0 will come here. This 7 will come here. Second. If 3 digits were given here, then you will substitute 640. If 4 digits were given here, then you will substitute all the 4 digits. Keeping in mind that selling rate has to be more than buying rate. Therefore, the ask rate will be 1.3670. And then D, £1 is equal to, like this point number B, this is also a bit complicated. People who don't know the convention can make mistake here. £1 is equal to, keep writing, $1.3640 slash 10. Now if you write like this, ask rate is 1.3610, it is lower than the bid rate. Again, the bank will become bankrupt if they give such quotation. So you will have to increase this number. If it was 6, you just increase it to the next higher number 7. Now you see it is consistent, 1.3710. So even if you are in a hurry, your ask rate cannot be less than bid rate. So I hope you have understood. Most probably in the exam A and C, appear 99%, but in some cases a quotation can be given like this. So be careful, ask rate is more than bid rate. Banks should not suffer the loss when they give the quotes. Next paragraph, to keep you engaged, motivated, I will ask you to write again one more paragraph. Factors on which bid ask spread depends. Factors on which bid ask spread depends. Factor on which bid ask depends. Write down one. Competition. First factor is competition. Higher the competition, lower the spread. Higher the competition, lower the spread. Suppose you have to buy dollar or sell dollar. On the main road there are so many banks where you can go and you can buy dollar. Because there are so many banks, each bank knows the customer can move to other bank if I quote a higher rate. So the spread will be lower. So maybe SBI is quoting like 75.40, buying rate 75.60. The ICICI bank will quote 75.38, 75.58. This way. Now you see the airport. Have you ever gone to an airport? Question number 1. Second, have you gone to international airport? Question number 3, have you gone to some forex counter there? Now there you know there is no competition. Customer has entered the airport. He has already done his boarding or taken the immigration checking done. Now he can't run out. Normally nobody would like to. But he finds that, oh, I don't have dollar. I am boarding the flight in next 1.5 hours and I don't have dollar with me. What will I do when I land in a US airport? He goes to the counter. Now that person in forex counter, this is what I was waiting for. So his quote will be, buying rate he will say 70, selling rate he will say 79. You want dollar? This is the best rate I can give you. You will say outside SBI was giving at 75.60. You will say go to SBI, take it, who stops you? And you know that you can't go there. Higher the competition, lower the spread. Second, higher the volume, lower the spread. So second factor is volume. In the wholesale market, the spread is very low. Like suppose SBI buys from Citibank 1 lakh USD. The spread will be very low, but you are a retail customer, you want $500, $2,000, the spread is high. Third is volatility. Third factor, right, volatility. Foreign exchange rate is fluctuating every minute. So the bank or the dealer who keeps foreign exchange with them, they are exposed to that volatility risk. In order to protect themselves from loss, they will keep the margin high so that to some extent they are covered. If you make more profit, it can compensate for a loss. So higher the exchange rate volatility or higher the risk, higher will be the spread. So these are the 3 reasons I have mentioned. You can add some more, just read some good books, do some research on your own. Point number 30, para 28. Para 28, write down bid ask rate is meant for. Why do spread is charged by the bank? The answer is simple. Why do an apple vendor charges more? He wants to make profit. He wants to cover his overheads. He wants to reduces risk. So first is in case of foreign exchange, it is like a commodity, it is like an inventory for the dealer. There are a lot of administrative cost. You need a human resource to do the transaction, you need computers, you have to comply with several regulations. So there are overheads involved. So first reason is you need to cover your overheads or administrative expenses, covering the administrative or overhead expenses. Bank is not a charitable organization. They also need to incur costs, so they need to at least recover that cost to run the organization. Second is to provide risk premium, because when you are dealing in foreign exchange, the rate of exchange is changing. So if you hold the foreign exchange, it is possible by the end of the day the rate has changed and you might suffer the loss. So you want to ensure that you are able to protect yourself from that fluctuation. So some margin is for that. And third reason is to provide normal profit. To provide normal profit, because they also want to make some profit. So of course, depending upon the situation, they will add the margin accordingly. If you are in airport, you will be looted by them, okay, in suit and boot. But if you are in the bank and where there are so many banks in the neighborhood, then they will give you a lower quotes. Next paragraph, write down middle rate. What is middle rate? Write down just one line, simple average of bid rate and ask rate. Middle rate is simple average of bid rate and ask rate. This is not very useful to us in our chapter, because if bid rate and ask rate is given, the bank will apply bid rate when it is buying foreign currency, the bank will apply ask rate when it is selling foreign currency. We have already seen the rules. Direct quote, buy high, buy low, sell high. Indirect quote, buy high, sell low. Now I have given you first golden rule today. For direct quote, buy low, sell high. For indirect quote, buy high, sell low. Now second thing which you tick mark, very important, second golden rule, which you will not forget till you pass this group, is purchase and sale transaction. You just understand these 2-3 points and the whole chapter I can take care of. Purchase and sale transaction. Whenever any transaction is happening, there are two parties, buyer and seller. One party is buyer, the other party is seller. Same thing happens when you are dealing in foreign exchange. Either you are a buyer or you are a seller of foreign exchange. In the foreign exchange market, two things have to be constantly kept in mind. First, the transaction is always talked of from the bank's point of view. So you will be given this rate. For example, I'll write some rate 73, 74.50. This rate is given by bank, not by the customer. Customer can't give rate. You can't come to our office and say, I want to pay for SFM 2000 rupees. You can't decide. I have to sell. I will decide the rate. So the rate is quoted by bank. First golden rule in this entire forex chapter, the rate is quoted by the bank or the forex dealer. Second thing, the rate is for foreign currency. The rate is referred to, item referred to is the foreign currency, or you can say the rate is for foreign currency. The rate is for foreign currency, whether it is direct quote or indirect quote, the rate is for foreign currency. Suppose this is rupees per dollar, it is direct quote, it means This rate is given by a bank. This rate is for dollar. At 73, bank is willing to buy dollar from you. At 74.50, bank is willing to sell dollar to you. So what I will do, I'll repeat these 2 points again. The rates are always quoted by the bank in all our question. Don't look at it from customer's point of view. Look at it from the bank's point of view. And second, the rate is for foreign currency. The rate is for foreign currency. For direct quote, the rule is bid rate. Buy, bank will buy at bid rate. Bank will buy low, sell high. And for the indirect quote, the rule is bank will buy high, sell low. If you can understand this much, our 50% job is done. People will tell you this is a difficult chapter, but it is not. The difficulty lies in identifying whether it is a direct quote or indirect quote. Which rate I need to apply for a given transaction, bid rate or ask rate. Whether I need to multiply or divide. But these are very fundamental things. Once you understand it, you will automatically start solving the problem. Then the question becomes like a simple arithmetic problem. So this chapter, I always say, is like a simple arithmetic chapter. So once again, in your note, it says in bold letter, when we say purchase or buying rate, it means the bank has purchased. Second, the bank has purchased foreign currency. When we say sell or selling rate or ask rate, it means the bank has sold and the bank has sold foreign currency. In last two line of paragraph 30, in a purchase transaction, as I said, always you have to look at from bank's point of view. So when I am saying it's a purchase transaction, it means the bank has purchased and bank has purchased foreign currency and bank parts home currency. Bank has and second, bank has purchased foreign currency. So when bank will purchase foreign currency, bank will give you home currency. Again, one more thing, whenever you have a doubt, draw this diagram. In a purchase transaction, bank purchases foreign currency. See the arrow. Foreign currency, bank is receiving foreign currency and bank is giving home currency. So you take a notebook. If you have not yet started writing in the notebook, then write name of the chapter, Foreign Exchange Management. Paragraph 30, one diagram. When I say purchase, it means bank has purchased foreign currency. Look at the diagram. If foreign currency arrow is going towards the bank, which means bank is buying foreign currency and bank is selling home currency. If you look at from customer angle, it will be exactly opposite. Customer is buying home currency and selling foreign currency. But I don't have to look at from the customer. You might make a mistake. We will look continuously in all the questions from the bank's point of view. Okay. Bank is buying foreign currency, bank is selling home currency. If you can just draw the diagram and look at the diagram, look at the arrow for foreign currency. If the arrow is towards the bank, bank is buying foreign currency. Now in a sale transaction, bank parts with foreign currency and bank acquires home currency. Again the diagram. Good student will keep writing. So now look at the bank. Bank receives home currency from the customer and bank sells foreign currency to the customer. So when this arrow which has foreign currency is going out of the bank, it means bank is selling foreign currency. Bank is selling foreign currency. Don't look at from customer. Look at from customer, opposite result. Customer is buying foreign currency and customer is selling home currency. Just to test you, is this diagram applicable for an importer or an exporter? On the screen, sale transaction. Is this diagram applicable in India to an importer or an exporter? The answer is importer. You are an importer. You have to make a payment of $1,000 to a supplier in USA. So you will give to the bank 1,000 into 80,000 rupees. Bank will take 80,000 rupees from you and bank will give you $1,000 to you. So this diagram is applicable for importer. For importer, always apply the selling rate. For exporter, the previous diagram, always apply the buying rate. Exporter, buying rate. I'll go to the previous diagram. This was the previous one. An exporter receives $1,000 check. He will give it to the bank. Bank will give him Indian rupees. So bank is buying foreign currency, giving him home currency. If you can just manage this much, my job will be easy. Now next paragraph, write down. Relationship between bid rate and ask rate. Relationship between bid rate and ask rate. Three columns. Particular column, bank column and customer column. I am repeating several times same thing because this is so fundamental in this chapter that once you get it, your job is done. Bid rate or buying rate. At bid rate or buying rate, write down there in your book or in your notebook, wherever you please. Bank buys foreign currency. Bank gives home currency. Bank buys foreign currency. Bank gives home currency. Customer. Look at the customer angle. Customer sells foreign currency. Customer gets home currency. But this is not important for us. Although in some books they will explain from customer angle, but we will not follow this. In all the questions we will follow this rule. The rate is from bank's point of view. In a bid rate, bank buys foreign currency. Bank gives home currency. Ask rate or selling rate. Ask rate or selling rate. Ask rate or selling rate is the rate at which the bank sells foreign currency and the bank gets home currency. Bank sells foreign currency, bank gets home currency. So bid rate is applicable to exporters and ask rate is applicable to importers. Customer buys foreign currency, gives home currency. Customer buys foreign currency, gives home currency. This is very important for this chapter. Now to understand this concept, let us solve one concept question, that is fourth number question, just to test you whether you are listening to me or not, whether you are understanding or not. This question has been designed not for exam, only for understanding. Question says the following are the direct quotes. Good. So one thing they have done easy for us. Following are direct quotes. Identify the country where the quote is made. So you have to identify in which country that quote is given. Then second, what is the bid rate, ask rate, spread, middle rate. Third is the currency being bought by the bank. And D, the currency being bought by you. You means the customer from the bank. Currency being bought by you from the bank. And now these are the 7 or 8 columns printed in your book. First column is quote, second column is rate. Then you have to write the answer bid rate, ask rate. The difference between ask and bid rate is called spread. Middle rate, currency bought by bank. There is some correction required in this last column. You have to write their currency bought by you from the bank. 3 words are missing. You from the. Currency bought by you from the bank. So first you try the first one, which is easy, rupees per pound. And it is a direct quote mentioned here. So if it is a direct quote and it is given rupees per pound, it means your home currency must be rupees and foreign currency must be pound here. So first we have to identify that if it is a direct quote, it must be home currency rupees, foreign currency pound. Now start solving. Bid rate. Bid rate will be this lower one, 76.2. Ask rate will be the higher one. Selling rate is always higher than the buying rate. It is a direct quote. Spread is the difference between these two. 0.52. 0.52. Spread. Middle rate is the average of these two. Take the average of 76.20 plus 76.72 divided by 2. So that gives me that middle rate. Now it is a direct quote. So the currency, there is a small correction in the question also. You have to mention here the currency bought by the bank in the case of bid transaction, because there can be two answers here. In case of bid, the currency bought is foreign currency, but in case of ask, the currency bought by the bank is home currency. So just please add these 4 words there. Currency bought by the bank in the case of bid. Currency bought by you from the bank in the case of bid. Now I think the question is properly drafted. So currency bought by the bank in the case of bid transaction. Bank buys foreign currency and bank sells home currency, means the customer will get rupees from the bank. Now you try this one. You try this one. US dollar per pound. US dollar per pound. It is a direct quote. You have to identify bid rate, ask rate, spread, middle rate, currency bought by the bank in the case of bid, and currency bought by the customer from the bank in the case of bid. So I will give you 5 seconds to try. Start. It should not take more than 5 seconds. Very quickly. Come on, fast. Try yourself. You can do it. Yes, you can do it. Take a pencil and try. Even if it is wrong, I will not mind. For some student, it may be very easy. Some student may find it difficult in the beginning, but I promise if you concentrate, if you practice every day, this chapter is very easy. So now let us check the answer. The rate given is USD per pound. If it is USD per pound, and if they are saying it is a direct quote, the home currency is USD. Foreign currency is pound. Bid rate will be the lower one, 1.6765. The ask rate is 1.6795. Spread is the difference between the two, 0.0030. Middle rate is the average of the two, 1.6780. If it is a bid rate, home currency is USD, foreign currency is pound because it's a direct quote. Bank will buy foreign currency, which is pound in our example, and bank will sell home currency, which is USD in our example. So this answer is over. Now we'll take a break.